quarter, I think the first quarter, I will be able to visit with you in person. I look forward to that. But I do want to take a little bit of time to present some information on where we are in the housing market. If someone could just give me an audio that you can see my screen.
Yep.
Yes.
Awesome. Great. Just to sort of go through where we are in the housing market there in Bucks County, as well as in the Philadelphia region more generally, and frankly, where we are in the market sort of nationally. As you guys all know, it is a very complicated market. It's a transitioning market. We've heard the word housing recession being used. I would actually argue that we're more in a housing resetting. But having information about your local market is even more important now than ever, because your buyers and sellers, even though there may be fewer of them in the market, they are looking for advice and guidance. And this is really where your professionalism shines in this market, where things are maybe a little bit complicated, maybe a lot of mixed messages coming at your clients. But let me take a look at housing market trends in the region, starting with the Philadelphia metro area. So, what we look at is the number of home sales in a given month compared to the same month a year ago. And so region-wide, the number of home sales was down 21% in September compared to where we were last year. Now, remember, last year was very unusually busy. And so it's not surprising that we've seen sales slower. We know mortgage rates are higher. Affordability is a bigger concern. We're seeing that sales are actually down even from 2019 levels, which is really indicative of the pretty dramatic pullback in both buyer and seller activity, which we'll talk about in just a minute. You can see on the right-hand side how the year-over-year change in closed sales looks across the region. In Bucks County market specifically, in September, the number of closed sales was about 20% lower than it was last year at this time. You can see that for the last really 12 months, year over year, home sales have been lower. Part of that sales activity being lower is just due to the fact that inventory is still really tight. So for a while, we were seeing a slowdown in sales activity simply because there wasn't anything to buy. But now, as you well know, we've seen mortgage rates rise faster over the last 6 months than at any time since we've been tracking mortgage rates. And now the average rate on a 30-year fixed is close to 7%. I bet when the data come out at 10 o'clock this morning, they're going to be at 7% according to Freddie Mac, which is double, right, where they were 6 months ago or a year ago at the beginning of the year. So that's what that blue line is. And you can see as the blue line started to go up, which is rates rising, home sales started to go down, which is what we would expect. But it's a little bit more complicated than that. And it's not all about rates. And I just want to I'll come back to that in just a minute. Prices are still rising, right? And so I think there was a lot of concern that as mortgage rates rose, we might see a big fall in home prices. But region-wide, a median sales price in September was up 6.5% compared to a year ago. Now you can see that that's lower than it's been, right? But it's still a stronger price appreciation than we would see in a typical year. So typically home prices would rise, 3, 4, 5% year over year. And at the region level, we're still seeing home prices up 6.5% compared to last year. And in Bucks County, frankly, September was a pretty strong month. There's a lot more variation at the local level since the median sales price, sort of depends on what is sold in the market. But, home price, the median price up more than 15% compared to a year ago. So the buyers that remain in the market are still finding pretty low inventory, and that's resulting in these home prices still having some upward pressure on them. I expect we will start to see both year over year price growth decline and perhaps even home prices fall from their peak in the months to come. But that will still leave us well ahead of where we were in terms of prices back in 2019. But it is a period of adjustment. And I want to talk a little bit more in a minute about this seller adjusting expectations. Inventory, still remains pretty low. We had a little bump in inventory metro-wide in July. Inventory up just 2% compared to where we were last year. In Bucks County, we are actually seeing the last couple of months, inventory was still, falling year over year. And so as we hear stories about inventory on the rise, keep in mind that in Bucks County in particular, inventory is only 40% of what it was back 3 years ago in September. So if folks had 10 properties that they could look at 3 years ago, now there's only 6. And so there is still fewer buyers, but inventory has not expanded all that much. And there's just 1.1 months of supply in the county. Typically, we call 5 to 6 months of supply maybe a balanced market. And we've been hearing conversations that we're shifting into a buyer's market. But all data point to me that we're still in a very tight inventory environment. And the reason why we're seeing inventory expand a little bit is not because we're seeing a surge of new listings coming onto the market. In fact, new listings are still down compared to last year, compared to 2020, compared to 2019. People are not as willing to move now if they've refinanced into a sub 3% mortgage, and now rates are at 7%. So we have a lot more people who are staying in place. Inventory has risen a little bit because buyers have left the market. So new pending sales were down 27% compared to a year ago. Homes are then staying on the market a little bit longer, and that's what's causing these inventory increases that we're seeing. In Bucks County, we actually saw a bigger drop off in pending sales activity compared to where we were last year, down 32%. And so what that suggests to me is that not only is seasonality returning to the housing market, but all of those economic factors, including higher rates, affordability challenges, frankly, just economic uncertainty, are really coming into play in the market to shrink the buyer pool and to slow those new pending sales activity. This can feel really scary, right? Sellers might be saying, well, I heard there's no buyers in the market. Why should I list now? But what we're seeing is that when homes are coming on the market and are priced appropriately, they are still being sold relatively quickly. And while the median days on market has started to increase, you can notice at the regional level, we're still really low compared to historic patterns. So homes are still selling relatively quickly, right? If you look at Bucks County, for example, median days on market 9, right? What that means is half of all homes are still selling in less than 9 days. And that is well below where we would be prior to the pandemic, right? If you look back at 2018 or 2019. So just to sort of show you the Bucks County data. So in red, this is median days on market, which really fell. Look at how dramatically the median days on market fell, how fast homes started to sell right around when the pandemic hit, right? April, May, June of 2020. And it has stayed very low since then. So even with this uptick, buyers who remain in the market are still finding a pretty competitive market. It's just there's fewer sellers and fewer buyers, and the calculus for buyers has gotten really different. So just to talk about that, watching my time here, to talk about that, that sort of outlook, we are, as I suggested, in a period of a transitioning housing market where sellers are resetting their expectations about prices. But I will tell you, it is not easy. We talk a lot about housing being a financial or home ownership, home buying being a financial decision, but it really is an emotional decision in a lot of ways. And we are seeing about 40% of sellers dropping their asking price, but they're coming to that realization slowly. I like to say they're coming to it through the 5 stages of grief, right? You sort of have to go through depression and anger about, the fact that you're not going to get this sort of price you had hoped to get, and need to really come to acceptance of pricing to today's market. And again, this is where the expertise of a local realtor is so important, that you can't expect your seller to be looking at their home valuation on one of the public portals and being able to use that information. They can't look at what their neighbor sold their house for a year ago and use that information. It's really about helping them understand the current environment where buyers have less purchasing power. And sellers are getting that. You can see that in Bucks County, for example, homes that have been on the market for more than a month, more than half of sellers have adjusted their prices. And I expect that this is going to kind of reset. They're going to be able to set that initial asking price more appropriately, because as I said, when prices are set at today's market, they are still selling pretty quickly. Even when sellers drop their prices, typically they're only dropping it by a little bit. So if you look on kind of at the far end here, homes that are on the market more than a month, the seller typically drops the price by an average of 7.7% across the Mid-Atlantic. I was going to do some quick math in my head, but I can't do the quick math. But if it's on a $400,000 home, dropping it 10% would be dropping $40,000. So dropping it, 7.5% would be probably dropping it about $30,000. And then 6.7% is the typical price drop if homes have been on the market for a long time. But look, it takes sellers a while. And as you know, the longer homes remain on the market, the more necessity there is for sellers to adjust their prices. And even if it is still a seller's market, and it really is still a seller's market, buyers do have more leverage now than they've had in the last 2.5 years. And price is one place where they're going to ask for concession, along with home inspections and home appraisals and other contingencies that basically went out the window during the pandemic. Buyers are having that leverage, and sellers are going to need to be prepared to negotiate. And those who are in the market are dropping their prices. They need to be able to negotiate. But frankly, some sellers are just staying on the sidelines because, as you know, most sellers are buyers. In fact, 75% of folks who sell a home are going to need to buy a home. And they're facing the same economic challenges with higher rates and sort of economic uncertainty. So the number of new listings, as I mentioned, is down compared to where we have been over the last few years. The dark orange line is the number of new listings coming out every week. So at Bright, we have weekly reports that we post to our website on market conditions. And if you notice that, look at that dark orange line, it really dipped down. So the number of new listings coming on the market has really dropped, not only compared to where we were the last couple of years, but certainly lower than 2019. And there's always kind of a seasonal drop off in new listings in the fall, but this drop off is even more dramatic. So my point with this is we're seeing buyers pull back, but we're also seeing sellers pull back. Buyers who are in the market are having to reset their expectations. So, for example, last year in September, the median sales price across the Mid-Atlantic was about $350. Average mortgage rates were 2.9%, though. So what we've seen is prices have risen 6%, again, regionally, but the typical monthly payment to a buyer has risen by 60%. So imagine you were out looking for something last year to buy, and now all of a sudden the price is 60% higher. There is significant erosion of buyers' purchasing power, and this is the environment in which now these transactions have to take place. So buyers are resetting their expectations. They're maybe looking at different types of properties. They're looking to you for advice for how to handle making an offer on properties that might need work or that might be outside of the initial district that they were looking in. And so this is the environment that I think we're going to be facing here for the next few months as rates remain elevated. The one thing that's kind of interesting to me anyway, and it's something I'm keeping an eye on, is while we know that buyer traffic is down, we know that closed sales and pending sales are down. We also know showings are down. We collect data on the number of actual showings where, your buyer requests a showing, or you request a showing for your buyer and they go in and take a look at a home. The red line shows where we are this year, and we're down in terms of the pace of buyer traffic through homes compared to where we were in 2019. It's interesting, though, we also have data on sort of basically clicks on homes, like how many agents are sending properties to prospective buyers and how many buyers are clicking on those properties. And in the Philadelphia area, even actually across the region of the Mid-Atlantic, we're seeing that the public views per listing is up, meaning that there's fewer listings available to look at, but the buyers, there's people still clicking, there's people still lurking. And I'm thinking that these lurking buyers may be waiting for a dip in rates. And so we may actually see a flurry of buyer activity if we see rates fall, 1 week. And there is going to be volatility in rates. I think we're also going to see buyers who are going to act if they see the perfect property, because like I said, showings are down, but viewings are still up. So we are still looking, even though we may be holding off on actually acting. And rates are really the biggest factor in the market right now. The typical rate on a 30-year fixed rate mortgage is close to 7% now. Holy cow, right? So that's up more than double from where we were earlier this year. It is higher than where we were, back 15, 16 years ago. And I think even more important, rates have risen more quickly than we have really ever seen before. So while we can tell buyers who are in the market that rates are up, they're not as high as they've certainly been. It is still a punch to the gut, right? To know that a year ago you might have been seeing a rate under 3%. I don't think that I think that there's going to be a lot of prognostication about where rates are going to head. I think we're probably going to be in this elevated 7 to 7.5% for a little while. The Federal Reserve will raise the short-term rate, which is that light blue line, again, at least a couple of times, and to try and tamp down inflation, and that will have an impact on rates. Not as much as maybe it did early on. Some of the rate hikes from the Fed are baked into these mortgage rates already. What I'm paying attention to is that dark blue line. It is the yield on the 10-year Treasury, which is tracks very closely to mortgage rates. And it is also data that you can look at every day if you were so inclined. And as you see the yield on the 10-year Treasury rise, that is a good indication that mortgage rates are also probably headed up. The thing that I think is important in this transitioning market is, while rates are higher, there's also a lot more variability across lenders in terms of both rates and terms. And so it's more important than ever that if buyers are looking to purchase, that they are shopping around at least with two lenders to get quotes on what their loan might look like. And these decisions are becoming more complicated, right? A couple of years ago, or even last year, a 30-year fixed was the only game in town. Why would you not borrow money at below 3% for 30 years? But now we're seeing a rise in the number of adjustable rate mortgages that are being issued. And it's important to remember that these ARMs this year, these are not the same ARMs we had back in 2006. These are not subprime loans. The folks qualifying for these adjustable rate mortgages tend to be as qualified as any other mortgage that they're applying for. But the spread between the adjustable and the fixed rate mortgages has widened. And so there may be more opportunities for buyers to explore an adjustable rate mortgage, but they need to understand them. They need to understand the risks involved. They need to understand the sort of maybe worst case scenario when the rate resets. And that's when you and your lending partners become really important to buyers in this more complicated environment. So as we look ahead, I think we've heard a lot about, and this is my second to last slide. When we look ahead, we hear a lot about prices falling, and the headlines are really confusing sometimes. And I do think there is very clear evidence that we will see home prices fall from the peak of where they were. And our peak was in June of this year. If prices do fall from the peak, they will still be well above where they were in 2019. So even if prices fell 10% from the peak, we will still be 20 or 30% higher than where we were back 3 years ago. So if I do my math correctly, that's still a sort of 8% annual price appreciation for someone who bought 3 years ago. If there's someone who bought in the summer and they want to sell in a year, they are going to find themselves in a tricky situation. But for folks who have bought and are staying, these falls from peak in terms of prices should not have an impact. I tell people, folks are told not to check their 401k every day. Do not go online and check your Zestimate or your home valuation if you're not planning to sell your home, because those estimates of home values are coming down. But if you're not looking to sell and you feel comfortable with your current monthly payment, there's really no reason to be paying that much attention to your home value. Home prices will stabilize. There are some places that are at greater risk of prices falling more sharply. These are places where, frankly, home prices rose really quickly during the pandemic. A lot of the coastal markets, Jersey Shore, Delaware, and Maryland coastal markets, where there was a big surge of second home buyers, and those second home properties may start to come onto the market, and demand for those properties has eased. Any markets where they saw like Zoom towns, right? People coming in to work from home outside of the big metro areas, particularly in some of our markets you can see out in the Shenandoah Valley, north central part of Virginia, but also some parts of central Pennsylvania where there was more interest in sort of living further out. You can see Bucks County sort of in that light yellow where sort of a, very, very little risk of big price drops in the major metropolitan areas. So to conclude, and again, if there's any questions, I know we're sort of tight on time, but if I know Robert's there and other folks, if there are questions, we can feed them through that mechanism. I'm happy to take them. But in the near term, I really do think we need to be paying attention to these economic factors, watching the inflation numbers that come out next month will be important to understanding if the actions of the Federal Reserve are making a difference, or if we expect the Federal Reserve to move even more aggressively on rates, which could increase the risk of us entering an economic recession and sort of change the whole economic picture to one where conditions might be a little bit more precarious for the housing market. But the one thing I can say is that we are still going to have low inventory because the economic factors affecting buyers are also affecting builders and sellers. Inventory will still stay low. Prices may come down from the peak, but they will still be higher than they were 3 years ago. And as I mentioned, there's some local markets where there might be prices falling more quickly. Frankly, some opportunities for buyers who might be looking in those markets. Further ahead, after we move through this transitioning market, we really do have strong demographic fundamentals to support strong demand. We'll still have a limited inventory as boomers are really kind of locking down supply, remaining in their homes longer. And as I started the presentation with, there'll be a lot more local variation in housing market conditions. So now more than ever, it's really important for buyers and sellers to rely on a real estate professional and local real estate knowledge because the picture is a little more complicated than it was. It's less frenzied for sure. There's more time to breathe, more time to think, but there is a lot more uncertainty out there in the market. This is my contact information. If you ever want to reach out to me, please don't hesitate with any questions at all. You can also find on our website our monthly reports, which include Central Pennsylvania and the Philly metro area. We also do weekly reports, which cover Pennsylvania overall. And then we have a whole bunch of blogs and other resources that you can find there on housing market conditions. So with that, Robert and the gang there in Bucks County, I'm going to stop and I'm going to happy to take questions, although I am also aware that you have lots of other things to do today. So I will end with that.
Any questions? No? All right.
I will send the PowerPoint slides out later today. And so if any of the charts are helpful when you're in a listing presentation or talking with colleagues, please use whatever's helpful.
Perfect. All right, Lisa, thank you.
Thank you.
All right. And just so you guys know, there are some